Hi there, my name is George Agan and I'm a Chartered Financial Planner. In this episode, as part of the basic series called Index Fund Explained, I want to explain what is an index fund and why is it a useful thing to know about. So firstly, why have an index fund? Okay, so let's first start with the idea behind index funds and why they exist. Let's say that you want to start investing. You hear it's a good idea and you invest in a single company. And in this example, I'm going to use Tesla because it's a familiar name. We don't really have any idea what the future holds for this company, but with any individual company, there's always quite a lot of risk putting all your money there, be it Tesla or be someone else. For example, what happens if Tesla has a huge supply chain issue? Their electric cars have some safety issue. Or, I don't know, maybe the CEO wipes off 14 billion of the company's value in a tweet. Don't think that would happen though. There's also what's called sector risk, which is if that was your only investment in the sector, we don't really know how the market that Tesla's in will develop. It could be a huge success, but it might not be. So hopefully you can see you've got a really concentrated risk in one company. All your eggs are in one basket. So now you might be thinking, wait, I'm more clever than that. I've read Intelligent Investor, and Benjamin Graham says if you hold between 10 and 30 stocks, you can spread your risk. The problem with this, as I mentioned in the 4 harsh truths about owning stocks, is that the data shows that a very small amount of companies are very successful and contribute to a huge amount of the market return. The rest don't really do that much. So you could have what seems now a great company, and you might even have a really successful industry. But how without hindsight do you know that you've backed Facebook, not MySpace? It's really hard, if we're being honest with ourselves, to know that 20 years going forward, who's going to be the next Amazon. And if you're honest enough with yourself and aren't one of those people who Kev, I knew it, they'd be massive, then I think you can understand the problem here. So what an index fund aims to do is not to win big on an individual stock, but place safety in numbers and get the average return of the market. There's also the added factor that because you can own a small proportion, you can buy pretty much whatever amount you want. So you can start at much smaller levels. So for example, if you wanted to purchase a buy-to-let property or even some shares like Berkshire Hathaway's A-class, then there could be a minimum amount you'd need to put in. Simply put, index funds are an indirect way to own a small part of a very big market. So what is an index? Well, you've probably heard a few of them on the 10 o'clock news. Normally when something bad happens.
8% at one point, and the FTSE, I can tell you, is now officially in bear market.
Dow Jones Industrial Average had its biggest single-day fall ever. At close, it had lost more than 11.
So the FTSE 100 is the largest 100 companies in the London Stock Exchange by market capitalisation, basically how much the companies are worth. You also might have heard of the S&P 500, which is in America, which is the 500 largest companies in the US. There are lots of indexes all around the world. And the idea of an index is it provides a level of replication on what a market is for a certain country, sector, or whatever. The idea is that you can give you access to thousands or even tens of thousands of individual stocks through the index. You can't actually invest directly into an index. An index is just a mathematical construction of stocks. You can invest in an index fund, which is basically a fund, which is a collection of the stocks that make up said index. Index funds specifically don't try and beat the market. Instead, they try and be the market, buying stocks from every firm listed on an index to mirror the performance. The idea of this as a whole is that the potential benefit is that they can keep the costs down. The potential disadvantage, you could argue, is that they are just trying to match the market return and you just get the average. The other possible advantage is that it's not just limited to stocks. You can have index funds that are in different asset classes, such as bonds, which are basically loans to companies or governments. So these funds are often called passive or tracker funds. Now, the truth is that some indexes like the S&P 500 are actually selected by committee, but that's a topic for another video. The point is there is no human interaction, or very little, so you get what the market return is. Why is this worth bearing in mind? Well, let's imagine you invest in an index of which the country is 40%, mining. That is clearly a large sector bias. So it's definitely something to watch out for, because here you might be getting a lot more sector exposure than you'd expect by just having access to the broad index. One of the more important things to remember is that the FTSE 100 index is actually quite heavily weighted towards financials and energy, As in June 2020, financials made up about 17.7% and energy about 10%. Another characteristic of this index is its relatively small exposure towards technology companies. So when you're seeing the difference in performance across indexes, this is something to bear in mind. The reason why they have become quite popular is because, frankly, the undeniable truth that the data for active management isn't particularly good. In fact, the vast majority of them have failed to outperform the market over the long term. Now, there are active managers out there who do beat the benchmark, but on average, the research shows that the majority don't. So why do investors like index funds? So number one is the cost. As an index fund just tracks and indexes, the investments are aggregated with other investors. This in general can be a lot cheaper than the active counterparts. So another reason is simplicity. An index fund is relatively easy to understand and it takes very little to maintain. So you don't have complex needs, or if you just want, for example, a simple portfolio, such as an index fund which rebalances automatically, they can be very quick and a sort of a one and done approach. Another one is diversification. So do you remember when I said about concentration risk? Well, a range of index funds is really the opposite to this. The idea behind this and why diversification has been called the only free lunch in investing is that, yes, generally you wouldn't be expected to shoot the lights out for return as you might get with a single stock. But the chances that the market is going to zero is extremely, extremely low because you're so well diversified. So let's go over why investors might dislike index funds. Well, little individual choice. As you bought a basket of investments, you're not usually able to choose what individual investments you may want to buy. Another one's market returns. So index funds are not designed to beat the benchmarks. Some argue that in the event the market fall, index funds are unlikely to cushion you against a decline, simply because they're designed to mirror the performance of financial markets. I don't want to get too much into this, but that's what some people say. Okay, so let's just talk a little bit about Vanguard. And you might ask, who are Vanguard and why are you mentioning them? Well, it's certainly not a recommendation to use them, but if you are talking about index funds in general, they were the first on the scene. So understanding their story is useful to know because it explains the history of index funds and how they came to be. It goes back to the founder, John Bogle. He started his career in asset management and had arguably quite a revolutionary idea at the time in 1975, which is in having a mutual fund company which is client owned. This means that the shareholders who own the fund, which in turn own Vanguard, and the profits are returned to those shareholders by reducing fees. Initially, John Bogle was pretty much laughed at by the industry, but word and popularity started to spread. This reduced costs further, and Vanguard was able to slowly, steadily lower its costs, with the average weighted fund expense ratio going from about 0.68% in 1975 to about 0.35 in 1990, and now even up to about 0.09 in 2020 on some funds. The idea of simply low-cost access to the markets really was the starting point for all the apps from Moneybox, Robinhood, Trading 212 out there. And before that, if you wanted to actually get into stocks, you'd likely have to call your broker or advisor directly. So it did in many ways democratize an element of investing. There are lots of other index popular funds providers out there like iShares, Fidelity, so do your own research and of course get advice if you're unsure. So I hope that made sense. It gave you a bit of an overview about what index funds are. As always with investing, make sure that you've asked all the questions that I highlighted in that Investing for Beginners kind of starter episode. But this has been Principles Personal Finance. I really appreciate you watching. I'll see you later.